If you're looking in terms of your risk-free rates and the price multiples that we are seeing right now on the S&P, you're looking at around about 19.5, pushing towards 20 times. But realistically, when you've got the 10-year continuing on this upward track, you would think that the calculations of the risk-free in terms of the CAPM is going to drive some of the equities down. So is it more about finding or being selective and in terms of what you are looking for over the course of the year in the run-up to what you're suggesting? And if so, where are you putting your money?
Unquestionably, Will. I think you nailed it. I think it's putting it in perspective. So we saw the 10-year yield up to 288. I think it settled out at 285 today. But think about the last couple of peaks. In October 2018, the 10-year got up to 325. In January of 2014, the 10-year peaked out at 303. And many of these groups did well. So you've seen a massive sell-off in some of the innovation stocks, in some of the interest rate sensitive to long duration earnings. But what you're seeing is an excessive crowding in Q1 into cyclicals, into commodities. You know, many of these commodity stocks and banks in particular up 100, 200, 300% off the pandemic lows. And now everyone's crowding into them and they're dumping tech, they're dumping innovative tech, value tech. And one group that we like in particular is biotech. Biotech has a low correlation to GDP growth. And while we had GDP growth of 5.9% in 2021, it's going to be much lower, still above trend, probably 3.5 to 3.8% in 2022. And we want to start to look to those sectors that have sold off in the fear of the hikes. And now that we're getting the hikes, that can perform in a slowing GDP environment and possibly a mild recession environment in 2023. And that's why we like biotech. If you look at biotech, you know, if you look at the average multiples of this sector since 1986, first off, the sector's corrected 50%. It did the exact same thing ahead of the last tightening cycle from 2016 to 2018. So it corrected in 2015 in anticipation. We saw in 2021, the last few months, correcting in anticipation of tightening. In the subsequent 2 years, from 2016 to 2018, while the Fed was tightening, the sector appreciated 140%. Right now, after this crash that we've just had, 50%, the sector would have to appreciate 24% to get back to its average price to book multiple since 1986, 155% to get back to its average price to operating cash flow, and 112% to get to its average forward PE multiple. You've got 16% of the components of the XBI, which is a biotech equal weighted ETF in the US, trading at 2 times cash on the balance sheet. Many are trading at a discount to cash, and it's the lowest price to sales in over a decade.
And that's probably going to be good news for Cathie Wood as well. But speaking of something that a lot of people are paying attention to, what do you make of what's been happening with Twitter? Elon's come in with that 5420 bid. The board's playing a little bit of shenanigans with their own nod to 420 when it does come to the poison pill. But realistically, at that kind of evaluation, or perhaps a little bit more, should they just be saying yes in order to maximize shareholder value?
There's no question. But, you know, you have the principal agent problem. I mean, they have a cushy setup. Most of them are ex-Jack Dorsey, don't own any stock. They get $200,000-$300,000 to show up 4 times a year. And they don't want to give that up, and that's understandable. But I think when you get a 6 handle in front of that bid, they're going to have no choice as fiduciaries, and they'll have personal liability if they reject it, to not take that type of a deal. And with Apollo coming to bear after the close, there were rumors that the private equity group could be a financier for Elon Musk. I think we do get a 6 handle, and maybe if push comes to shove, given Elon's comedic nature, maybe it gets up to 64.20. But I don't know if he's going to go that high. If he did go in that range, that's probably the number he'd come to.
Yeah, talking about comedic talent, we were actually joking whether or not it might actually go up to 69, but we'll leave that for another day. So in other case, look, what you're basically saying is Apollo and Musk is going to drive the offer to 60, 65, and there's absolutely no way that the Twitter board is going to not be able to say yes to that.
That's correct. Listen, this board, they've delivered zero value for shareholders since the IPO. So that's a tough track record right there. Number one, they have fiduciary liability there, delivering zero value since the IPO. And then number two, when you get up to that range of 60, 63, maybe 64. I don't know if Musk will go that high, but anything with the 6 handle, they have to seriously consider that and probably take it, turn around the company. And I think if there's someone that can turn it around, it would be Elon Musk. Attract a lot of influential people that haven't been engaging, that haven't been tweeting, to get back on the platform, to become active and draw in a lot of monthly active users that have been dying.
Maybe even Alex Jones and Donald Trump. Who knows?